Interest rates might start to come down sometime in 2024, but recession and mortgage renewal risks are still very real. And so these two might end up balancing each other out and limit short-term gains. And this is precisely why we're so big on rental income, because it is a more reliable way to make money with real estate and also helps you scale better with the mortgage side. And that's why we always end up going back to houses as our go-to investment in Toronto. And moving forward, we see good prospects for a strong market in Toronto simply because there's just a lot of housing policy changes in the low-rise market in Toronto, and there's more to come. And so what this means is that it's good for those who are willing to take on more development, but news of this will also simply attract more attention to the Toronto market too. Now, there's two types of houses in Toronto that stand out for us as the best opportunities for 2024. The first one would be gentrifying areas that do have good growth potential as improves and do have amazing cash flows right now. And secondly, prime mature areas where prices have actually come down a lot more than average in the past year and a half because of affordability issues. Now, out of these two, which one would be our top pick? Well, that's what we're going to be answering today. And if you're new here, I'm Samantha Chan from Elevate Realty, and our brokerage wants to help you make smarter real estate choices in Toronto. Don't forget to like and subscribe if you enjoy our content. Let's begin. Let's take a closer look at our top two investment options. The first option would be gentrifying areas, and you will find lower entry prices, better rent yields, and very, very strong positive cash flows in today's environment. The added perk is the potential for substantial growth as the area develops. On the other hand, we have option two, mature but also pricier areas. But then they also saw big drops in prices over the past year and a half, and so they are a lot more affordable these days. Now, cash flows aren't as strong, but they do have the potential to bounce back more than the average Toronto market on recovery. So let's take a closer look at the numbers, and for this analysis, we'll assume a market appreciation of 3% a year and a 10-year investment horizon. So for option one, this is something pretty typical for new investors in Toronto. You would buy a house for around $900,000, and then you would add in around $70,000 for renovations. So all in all, you would need $280,000 to get into this investment in Toronto. And then after upgrades, this property might be worth around $1.04 million. Now let's look at rents. When we usually look at this, we take a look at cap rate as a real estate investor, which is basically the rent yield on the property. And what we do is we would take the net operating income annually and divide that by the market value of the property. So when we do this, the option one's cap rate would be around 6%, and that translates to $1,000 of cash flows per month. On the appreciation side, there is a potential for higher growth, and let's say that we will see 1% better than average appreciation per year over the next 10 years because of gentrification. And this would translate to a total return of 10.7% per year if someone bought in cash, and it can be much better if you invested with borrowed funds. Now let's take a look at option two today in Toronto's mature market, where we are seeing big discounts for those properties that need a lot of work of around $200,000. Now in today's market, you might be able to buy this house for $1.1 million. So that actually takes our capital requirements to a much higher $460,000. The plus here is that the more renovations you put in, the more value add you typically get on the property. So after everything's done, it might be worth $1.5 million. For this investment, you do get a lower cap rate and you would get smaller cash flows. But if we factor in 10% more in price rebound compared to the average market over the next 10 years, we're still looking at pretty close 10.4% annual returns without borrowed money. So as you can see, both options do look pretty good, but option 2 does mean more money invested and less cash flows and returns. So we would have to say option 1, the gentrifying areas, would be our top pick in general. Now, one thing to keep in mind is that every purchase is different, and if you wanted a more accurate analysis, you can go through this exercise that we just did to compare individual deals more accurately. Now, I would say the best choice also depends on another factor, whether you would be building on the property. Here's what I mean. If you choose to build a backyard house, the cost of the build would be the same regardless of where you build, but the rents would be much higher in the mature areas. So rent yields can actually look substantially higher in the mature area. And then once you enter more of the development space, the returns in the mature areas can look even better, especially once more policies get approved in the coming months with the potential to build townhouses and up to 30-unit apartments on all major streets. So the main point here is that there's no one-size-fits-all answer. One or the other can be the better option for the right investor, and it all depends on things like your goals, your budget, your risk, the amount of work you want to put in, your comfort level, and your timelines. And if you still don't know what is best for you, just reach out to us because that's what our team is here for. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. If you want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.